The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague, the so-called soccer expert who couldn't have been more wrong about the mighty Socceroos. It's Anthony McDonald. How are you, Anthony?
Never been happy to be wrong, James. Go Australia.
Fantastic. Well, this week we examine the government's budget backdown. We explain why Australia and America's central banks are talking more about rate rises, and we take a question on whether AI could change the way your super fund has to invest.
James, as we record this morning, Friday morning, KPMG is getting brutally grilled at a parliamentary inquiry over its audit scandal. We're going to do things a bit differently today because this is playing out in real time. We're going to have a chat late on Friday just before we publish this podcast and bring you all of the drama from these hearings. Stick around for that later in the podcast.
Oh, I can't wait, Anthony. All right. Elon Musk's rocket stock IPO, SpaceX, is still the biggest talking point in markets a week on from its float. The stock soared on listing and it's been up 3 of its first 5 trading sessions. It last traded about 40% above the IPO price. Investors are valuing this company, Anthony, like it's Amazon or Microsoft. Please tell me, is this real or are we looking at one of the biggest meme stocks ever?
Good question, James. I mean, first off, hats off to SpaceX. I mean, no one's regretting buying the IPO, right? That's the first test. Can it keep it up? There's a lot of hot money and a lot of short-term factors that went into buying the stock at the IPO, I think, and SpaceX couldn't have asked for much of a better backdrop to do the float. You know, the market, it's been very much risk on, you know, right in the thick of the action. Donald Trump's got his claws all over Wall Street and everyone's just want to buy risk, right? Like, so NASDAQ's up 25% since the end of March, right? And then you drop this thing in there. So the backdrop's absolutely been perfect. As we said before, you can't justify what's now US $185 a share price or the $2.4 trillion valuation by conventional means. You really got to think 5 years out, and so much can happen in that time. I mean, the bull case, James, it's all about the rockets, all right? The more that SpaceX fully reusable Starship rocket, something it's working on still, can launch daily, relatively cheaply, get more of the stuff into space. I mean, that can bring the other stuff in, but James, there is a big meme stock element to it.
Totally.
I mean, we see that just in Australia's involvement. CommSec confirmed this week it had nearly 30,000 different customers bid for shares in the IPO. That's more than 4 times any IPO it's ever done in Australia. Right? So,
yeah, it's great.
Mate, that just screams meme stock. Yeah, we've seen this before in IPOs, even Australian ones. They can really catch a light when they first come on. Keeping that up 1 year down the track, 2 year down the track, it's really hard. I mean, if anyone can do it, maybe it's Elon. But the whole thing's been completely nuts. What have you made of it?
Oh, look, I mean, I think there's a famous short seller in America called Jim Chanos, and he called this a hope and dreams IPO. I think that's right.
Yeah.
We're a week on. I still haven't heard a concrete justification for why this company's worth almost $3 trillion US dollars, because there isn't one. I mean, you know, you said we need to think about where this company's going to be in 5 years' time. I mean, it's probably more like 15, 20 years' time. There's not going to be a data center in space in 5 years' time. I'm happy to be wrong like you were about the Socceroos, but I just can't see that. You know, we're not colonising Mars in the next 5 years, 10 years, 15 years, 20 years, probably 50 years. People are fitting their own narratives to justify their support for Elon Musk. You know, I've always thought he was a genius. Yeah, okay. Totally get it. But the hard work begins now for SpaceX. It's not going to be easy to justify this valuation, to grow into this valuation. Let's see how it goes. But Anthony, this is the nature of markets now. Everyone's just looking for the next bubbly thing because that's the way you make money. I mean, people are playing the system and you can't blame them for that. This is the way the world works now, isn't it?
Yeah, 100%. And like I said, hats off to SpaceX for giving everyone a good experience to date.
Yeah, absolutely.
James, let's stay in the US for another minute. Donald Trump finally secured a landmark peace deal with Iran, which is supposed to see both sides down guns and keep them down well into the foreseeable future. There's a lot in this deal, James. It was dubbed a 14-point US-Iran deal. Which of those 14 points caught your eye? And are there any longer-lasting consequences from this 3.5-month conflict?
Oh, I take you to paragraph 5, Anthony. I know you will have studied this closely.
Oh, yeah, paragraph 5.
Upon the signing of this memorandum of understanding, the Islamic Republic of Iran will make arrangements of using its best efforts for the safe passage of commercial vessels with no charge for 60 days only.
Uh-huh.
That's it. This is
60-day
no
toll
deal.
free.
This is a 60-day ceasefire. This kicks the can down the road for 2 months. Now, I mean, it is good that we've got a deal, beautiful signing ceremony in the Palace of Versailles. I mean, how good is that? But, I mean, I think this is the clause that matters. Does the Strait of Hormuz open quickly? Does it stay open unimpeded beyond that 60-day deadline? Or are we back at the negotiating table, or worse, the US and Iran are firing projectiles at each other 2.5 months down the track? I hope, and I think the global economy needs this to be a long-lasting deal. But it's more of as it says, it's a memorandum of understanding. It's a page and a half, You would have written longer meeting agendas for the local soccer club, Anthony. I mean, this is the bare bones of something that leads to a bigger negotiation. I guess my concern, Anthony, is that Trump is not a details guy. He's got a short attention span. He moves on from things quickly. So is the White House going to be able to nail this agreement down? But look, it's a good thing we've got this, because things are starting to really break in the energy world. There's a place in Oklahoma called Cushing, which is a sort of pipeline crossroads of the world. So oil comes in to Cushing from around the world and it's sent across the US. The tanks are starting to run dry in Cushing, and when the tanks run dry, all sorts of bad stuff happens. Pipelines don't work because the pressure isn't there. So this has come right in the nick of time. Donald Trump's approval rating when it comes to the economy is totally in the toilet. So everything points to this deal being real and sticking. I just worry that it gets to the midterm elections. The Iranians know they've got this leverage. Do you think in, a couple of weeks out from the midterm elections, they might chuck a couple of mines in the Strait of Hormuz and say, no, Donald, you didn't sort this out completely? I don't know. Are you confident that this is the real thing?
I mean, even if it is a real thing, we've still got these consequences that are playing out in the economy, right? So even if the peace deal still holds, and that's great. I mean, you've still got this inflation shock. You've still got the energy problems, huge ramifications. I mean, just look at Australia, all right? We had a budget commitment to spend $10 billion on fuel security, storage, looking at refining capacity, all that sort of stuff. Yeah. That wasn't on the political agenda before the bomb started going off in Iran, but we were happy to just limp along with what we had. And now we've signed up for the next 3 to 5 years to spend $10 billion on this stuff. And if we're doing it, we got through this relatively unscathed compared to a lot of economies, thanks to the fact that we're a wealthier nation and our businesses and consumers can afford to pay a bit more for petrol, diesel and aviation fuel in the short term. If we're doing this fuel security thing, you can imagine it rolling out across the entire world.
Yeah.
So, I mean, there will be consequences. And of course, it begs the question globally, will we be better or worse off after this deal's hashed out?
Yeah, that's a great point, Anthony. I mean, so we will see oil prices go down. We're already seeing that, but then we don't know whether they'll have to go back up again as if Iran does charge a toll. And we'll see these underlying inflationary pressures build as countries try and improve their fuel security, because that costs money to do too. You've got to invest in new tanks and new supply agreements and all that sort of thing. So there is a hell of a lot of moving pieces around the Middle East still, and I think it's going to be months before we totally figure out how all this plays out.
All right, James, let's jump into our first topic, and it's a story we've seen played out in politics plenty of times before. After the budget, backlash comes the inevitable backflip. On Thursday, the government announced a series of carve-outs from the changes to capital gains taxes and a backdown on part of its changes to trusts after a few weeks of outcry from all sorts of groups. James, take us through the key details.
The big carve-out here is for small business, Anthony. So if you had a small business that had revenue of $2 million, you had a 50% CGT concession. So that has been increased by 5-fold. So businesses with up to $10 million in revenue will now have that CGT concession.
Yep.
So that's a big move. Jim Chalmers says it covers 98% of all Australian businesses, which speaks to the fact most businesses in Australia are small businesses. A couple of other carve-outs. There is one coming for startups that have less than $50 million in revenue that aren't listed on the stock exchange and that have been going for less than 10 years. The investors in those startups will have a CGT carve-out. Now, there's a bit of consultation to go through there, and probably a little bit of back and forth from the startup community, but the direction of travel is clear. And then we've got this trust change. So there was a concern that testamentary trusts, which are used as part of wills, they were going to be taxed in a way that amounted to the dreaded death tax. So the government sort of headed that off and provided them with a carve-out that means they won't pay a minimum 30% tax, as discretionary trusts still will. So, yeah, I mean, these are rollbacks, backflips, however you want to describe them. But, Anthony, are you surprised that the government's had to give some ground here? Is this good economics or is this political expediency? And I guess the other question is, do these carve-outs cauterise the wound that this has created for Labor?
And what we've learnt, James, and this is not new news by any means. I mean, you can read about it back in the Bible. But people hate the prospect of paying more tax. They just do. People see their wealth or money as hard-earned, and very often it is. So whenever we have any tinkering with tax in recent years, both the way it's collected or the volume it's collected in, there's huge pushback.
Yeah.
So the CGT is just the latest example. I mean, we had the superannuation, remember, with Treasurer Jim Chalmers a couple of years ago, wanted to go after unrealised gains, and then he backed down and indexed the $3 million limit to concessional tax treatment a year. That was 12 months ago, James.
Yeah.
As soon as there's any tax reform, as it gets labelled, there's someone out there that's going to be worse off, and there's a huge outcry. Yeah. So what we get tinkering to the tax system without wholesale changes. And I'm not saying that's good or bad, but that just pointing it out. And on this one, I mean, the carve-outs are very clearly aimed at not going after small businesses. There's that argument going around that the hairdresser who ran a salon for, 20 years and employed 5 or 6 people, always done the right thing, paid tax, looked after customers, employed people, that maybe they'd want to retire up the coast, sell the business, and under this new regime, they'd get slugged with capital gains tax like they wouldn't have in the past. I mean, that argument, and I'm not sure it fully stacked up, but that argument should be gone now.
Yeah.
And it's gone because, like you said, that $10 million turnover, it's a decent hurdle. 98% of small businesses, like the government said, have less than $10 million of turnover, so they should be exactly the same as they are today from a capital gains tax perspective. I mean, in theory, a lot of people should be happier, but I'm not sure they will be, James. I'm not sure how many people out there in mainstream Australia understand the ins and outs of capital gains tax or that 50% discount or what indexing to inflation means. And until you can come out and call this a genuine tax cut without having to step through the complicated examples, I think there'll be pushback until you can call something a tax cut. And I'm not at all surprised the government made changes. We've spoken about it in recent weeks. They got the exact same pushback on the superannuation tax changes a year or two ago. This government's very tuned into politics. The polls have turned terribly for them since the budget. Rates are going up. The economy is slowing. Business and consumer confidence has crashed. And the government's feeling the heat.
Yeah.
And the government's problem is not just these tax changes, it's the general direction of the economy. That's what's really driving the discontent here. So when you've got a restaurant owner looking out there at their restaurant and half the tables are empty, and then there's this whole tax changes thing in the air, and they're wondering why people aren't spending, they just lump it all together, put it all under the topic of discontent, I think, which has really turned into a movement. James, you had a great discussion with NAB CEO Andrew Irvine, who runs the country's biggest business bank, for the AFR's interview series earlier this week. I really liked how he framed this debate. How does he see it?
Yeah, I agree, Anthony. He had this good idea of not thinking of these tax changes as about taxing wealth and labour. There's been an argument that we need to tax wealth more because the pressure on the people paying income tax is too great. Yeah, that's one part of it. But the way he sees it is the difference between taxing passive assets and risk assets. So a passive asset might be a bit of land or a bit of property. It sits there, its value goes up, but you don't really do a lot to improve the value. A risk asset is where you might suffer a loss. You risk your capital when you put it into a business. You risk your capital when you invest it in a stock market or a company or an early stage venture. And so his point is that what this CGT changes hit, and what they still hit even with these carve-outs, is the people putting their capital to risk in various ways. Now, we need people that want to risk their capital. That's how we get economic dynamism. That's how we get new businesses. That's how we get, this sense of growth in the economy. If people aren't encouraged to do that, and they do need a bit of an incentive to do that, then it all sort of slows down. And what Irvine argues is these CGT changes, they push against investing risk capital. And that's not the way we want this to go. I think that's a really interesting way of framing it. Passive versus risk assets. It does speak to what we want to encourage in this country, which is risk-taking. Our old editor Michael Stutchbury used to say risk-taking and growth-making.
Yeah.
And it's a good way of thinking about the difference between various assets. So I really like that framing. But can I just get back to something you pointed out here about the direction of travel for the government? I think it's worth stepping back from this episode and thinking about the chain of events a bit. My sense is that the budget backlash has sort of catalysed a bigger discussion about, where we are as a nation. Does the government have a plan for a more prosperous, dynamic economy? Because these CGT changes do seem to push against risk-taking. Now, Anthony, as the budget debates played out this week, we saw Pauline Hanson dominate the national conversation with her appearance at the National Press Club. Has this budget stuff up by Labor opened the door further to One Nation?
Oh, 100% it has, James. I mean, that door was already opening, and like I said before, it comes down to discontent, voters feeling like life's harder. The big swing factor here is the economy, or to be even more specific, the hip pocket.
Yeah.
It's a global theme. Incumbent governments, incumbent political parties are under more pressure and have been since the financial crisis, as voters are getting more frustrated, as they feel like the political system's not working for them anymore, that the days of easy growth and rising incomes and productivity and just living standards being better just aren't there anymore for them. So, that's what's fueling this One Nation rise. I mean, Donald Trump's been elected twice on it in the US, and now we're seeing One Nation tap into it here. I mean, if you wind back a few years, we've had One Nation on the scene for 20, 30 years, James. I don't think many people were tipping Pauline Hanson to be at the National Press Club with a speech that really was a must-see. She's got a groundswell of support now. Good on her, polling fantastically. And all of a sudden, we're now more interested in what the party really stands for, what are its economic policies. I know you looked them up a couple of weeks ago, but I think most people would be unaware of them. I mean, is she really for workers and everyday people, or is this just about making the rich, right supporters of hers richer? So, she stood up there, argued against multiculturalism, said we can have many races but need one culture. There was no welcome to country. She rallied against immigration, against overseas students, questioned how all of this has changed Australian values, and sort of really tried tapping into the social divide here between rich and poor. She pointed to a Salvo survey that said 19% of people had eaten food from a rubbish bin in the past 12 months. And like she said, One Nation would end the renewable energy bribery and fix energy policy. She tapped into this capital gains tax issue. I mean, she's milking that for everything it's worth. And why wouldn't you? I mean, this is politics. But One Nation's popular, but it doesn't count for Jack unless they turn this into votes at an election, James. They've got 6 elected representatives in Canberra, right? 4 in the Senate, 2 in the House of Reps. One of those was Barnaby Joyce, who got elected as a national and then crossed over. And then the other one was a by-election down in southwest New South Wales, the seat of Farrer recently. But the budget all adds to this growing discontent. It definitely helps open the door to One Nation.
Yeah, Paul Bassett, who's a founded Seek entrepreneur, investor, he had a great post on social media sort of saying that there's a political earthquake going on. For 80 years, we've had this two-party system, and all of a sudden it's being busted. Now, we don't know what that looks like come the next election, but I was struck this week, Anthony, talking to one of our top CEOs. They made the point that they're starting to try and understand what's changing in the political mood, and the line was, when 30% of your customers are moving in one direction, you better try and get your head around it. I think business is really concerned, rightfully so, about this anti-immigration line. Business loves population growth because it means more customers, but business also loves the vibrancy and dynamism that immigration brings to an economy and how important that is. So I think there'd be concern, but this change in the political atmosphere is something business is really going to have to get its head around. And And as you said, Anthony, so much of it comes down to what's happening in the economy, which is probably a good segue to our second topic, which is all about the economy. This was a pretty big week for central banks. And yes, Australia's RBA and the United States Federal Reserve both kept rates on hold, but they also gave investors and borrowers a lot to think about. Not for the first time, these central banks are facing a pretty similar set of conditions. Both places, inflation's too high, the oil shock is starting to push up prices and it could last for a few months. And these central banks are telling us to get ready for higher for longer interest rates. Anthony, let's start in Australia. Michelle Bullock didn't mince her words in the press conference on Tuesday after the rates decision. She seems really worried about inflation still, which means we all need to be worried about it too. What did you grab as her key message?
Oh, it's kind of like it has been for the past few months, James. Just inflation's too high. If we need to raise rates, we will. We're showing some patience in not raising rates right now, but there's sort of enough going on in the background that they can justify sitting around and not increasing them. But James, like in the Reserve Bank statement, I mean, it was like one sentence would talk about, the inflation pressures and why inflation might go up. And then the next sentence would talk about some pressure that maybe make it go back down, right? And it was like that through the whole statement. So I think just shows how much uncertainty's out there. And Michelle Bullock made it pretty clear, though, that one lesson of the past is that the Reserve Bank probably has to move sooner than it expects, right? It can't wait until the numbers fall perfectly before they do what they're going to have to do next. Yep. So I think I left the press conference sort of under the impression that she is willing to move and she's willing to move sooner than the data may suggest, but they just don't quite have the conviction to increase rates again just yet. What do you think of it?
Yeah, I think that's right. I mean, I thought she was actually pretty hawkish.
Yeah.
There was no sense that rate hikes are being off the table. We can afford to wait. I agree with you that she's really worried about where inflation's going. She's really worried about what's coming in inflation. She mentioned several times construction costs are rising. We're starting to see those second-order effects from the energy shock. So, I mean, UBS, they reckon there's another rate hike coming at the next meeting in August. I can see that. We'll get a bit of data between now and then, but I think Bullock is looking to the past and saying, we thought we'd tamed inflation before, but we hadn't. We cannot afford to make that mistake again, or else our credibility will be in trouble and the public's view of what inflation means will also be in trouble. It's a really tough position. And it's a similar position for the new Federal Reserve Chairman, Kevin Warsh. And look, Anthony, he's a man who generally isn't keen on press conferences and explaining things more generally, but he fronted up following his first rates decision, again, keeping rates on hold. What did you make of his appearance?
It was a fresh voice, wasn't it? And there's something about a fresh voice,
Yeah.
I'd say anyone that listened to our podcast would think that we thought Chairman Powell did a good job under the circumstances and he held it together pretty well. But you hear a fresh voice and you go, all right, change is healthy. You get the new guy come in, point out inflation's been well above the target, 2% for 5 years now. Let's review everything from the ground up. How the Fed makes decisions. What's the data it uses? How does it communicate to the market? Yeah. Warsh came out and he announced a bunch of task forces to rethink all this stuff. And those task forces might be a giant waste of time, but they might come to something. Maybe they will help them manage inflation better than they have been in the past. But, I mean, he's sort of short, sharp to the point, no forward guidance, says this will work best if markets interpret the statement, the data and everything for what it's worth and for themselves and not trying to second guess what the Fed makes of everything. He seemed to want markets to do a lot of the work, right? And forget about the Fed so much and just focus on the numbers that get put in front of them. I mean, he loved talking about a good family fight. He used it over and over. I mean, He clearly wants robust discussions at the Fed, in the FOMC, in all these task forces. The press conference itself, it was noticeably different, I thought. I mean, the nature of questions were very different to what Powell was getting, particularly in the past 12 months. It's to be confirmed whether we'll have press conferences after the review into the Fed communication. Warsh said he believes in them, but only when he has something to say. The decision itself was pretty obvious, though, wasn't it, James? I mean, I think investors look straight for the dot plots. 9 of the 18 officials said expect rate rises this year. I mean, that was a noticeable change, and it just shows how this sort of oil situation is brewing inflation, and it's going to be really hard for central banks to look past it. But yeah, I don't know. I quite enjoyed listening to someone different for a change.
Oh, I see what you mean, Anthony, but I think he's got a problem. I mean, Walsh was brought in, handpicked by President Trump as the guy to get interest rates down. Mm-hmm. He's now facing reality that's going to be next door to impossible for some time. So, okay, I do take your point. Fresh voice, playing the data as it lies, which I think is entirely reasonable. But how long is it before Trump's, tapping on his shoulder and saying, "Hey, Kevin, hey, remember what you told me before we made this appointment?" So I think it's going to get pretty awkward for Kevin Walsh in the next little while. But look, maybe maybe the market, as you say, rolls on and sort of any pain is limited. But I think it's going to be a really interesting little period for him over the rest of this year, as we see where inflation sort of settles, how hot the US government runs the economy, whether the US jobs market sort of holds up. There's a lot of tough things he needs to figure out. I think the big difference between where Kevin Walsh is and where Michelle Bullock is that the US economy is flying and Australia's is not.
Yeah, no, good point. You're right. Walsh does have a problem, but that's his problem. How he's going to manage the expectations and what he's pitched himself and what the data's going to say. But I'd say just generally this higher for longer feeling, I mean, it's now pretty embedded in Australian business and markets. We've had 6 months of it here, James. 3 rate rises, consumer and business confidence has tanked. Does this change the psyche of markets at all? I mean, we saw from SpaceX, the world's still pretty bullish. Australians want to be bullish as well. But shouldn't higher for longer rates mean something at some point?
Oh, it should. It should have meant something sometime over the last 5 years. So it's hard to sort of make the call that it's going to mean something, and really shake the confidence of investors next week or next month, because they've just been so well trained to keep buying the dips and everything will be fine. So, look, I think it probably means more. Higher for longer rates mean more for Australian investors when they look at the ASX. I think we're facing another sort of lost year on the ASX. I think we're holding a gain of about 2% year to date. Adjust that for inflation, we're going backwards. You look forward over 2027, probably unlikely that the RBA is going to be able to bring rates down and support the economy much because, it needs to tame this inflation beast. So does 2027 become a bit of a lost year too? I don't know. I think that will weigh on the minds of investors because they will look at America and SpaceX and AI and all the exciting things happen and think, all right, my next $10 of capital, where am I investing it? ASX or America? It's a pretty clear answer, isn't it, Anthony?
It is, mate. And SpaceX showed it. Like we said, 28,000 people, CommSec customers applied for SpaceX shares, 4 times more than any other float they've ever done, any other Australian float. So, yeah, there's this feeling that the ASX is going nowhere. I mean, people are showing that they feel that as well by where they're putting their cash now.
Yeah. All right, well, everyone's had the crystal ball out following the RBA's meeting and Bullock's address. As I said, UBS has got a hike in August and then on hold till November 2027. Cup Day, November 2027. What's your sense of where consensus is lying now? Like, what's the word on the street?
I looked it up on Friday morning, James, on the Bloomberg terminal. So from what the economists are saying, cash rate at 4.44% end of this year and 4.2% at the end of next year. So we're at 4.35% now. So 4.4% at the end of this year. That's saying sort of 1 in 2 or 1 in 3 economists are tipping one more rate rise this year, like your mates at UBS. And that's very similar to futures markets and what they're saying.
Yep.
I mean, 4.2%, that sort of says the other way, right? About 1 in 2 economists are saying a rate cut by the end of next year. So if you take the middle ground, James, these aren't wild swings either way, right? Economists are saying if you're like me and you're paying 6.09% on your mortgage today, expect to be paying about the same for the next 18 months or so, which is what you've been telling us for a while. I mean, like you said, UBS's George Thoronow, he came out this week and said one more hike and then sit around for 18 months. And I just thought that's sort of James Thompson's view of the world.
Yeah, I think that's right. I mean, I think we've got to take Michelle Bullock at her word. I mean, the other thing that she said repeatedly is we have to slow this economy down. There's just no way around it. To bring inflation down, we have to slow the economy down. And she said people shouldn't be alarmed at that, which I thought was a bit of an interesting way of phrasing things. Okay, I'm not going to be alarmed at it, but I'm not going to be thrilled about it either. Like, this is a real mess that is born of 10 years of failing to get productivity growing. Okay, I'm not going to be alarmed at it, but don't expect me to be happy about it. It comes back to that discussion about politics. This is why anger is building up in the community, because a slowdown's coming. We just have to take our medicine, but it's not going to be very nice at all, I don't think. And the danger, Anthony, Bullock was asked about this on Tuesday, the danger is that the RBA's calculus, and it's such an imprecise science, the calculus is slightly wrong. They want a slowdown that's big enough to bring down inflation. I mean, what if it tips over into recession? We hope we don't get there, and Bullock said the same thing on Tuesday. We hope that's not the outcome. But it's a bit of an economic game of chicken, isn't it? It's tough to find the middle ground and the Goldilocks narrow path, as they like to say. All right, Anthony, let's take a break now, and when we come back, we'll bring you that update from the KPMG circus in Canberra.
For the Hansard record, would you please state your full names and the capacities in which you appear today?
Andrew Yates, the former Chief Executive of KPMG Australia.
Julian McPherson, the former National Managing Partner of Audit and Assurance, KPMG Australia.
As promised, we wanted to give you an update on this KPMG parliamentary inquiry in Canberra. What's been the big narrative?
Well, I think, Anthony, it's been all about trust. I mean, the heart of this is about auditors, and as a former auditor, you know that in a strange way, audits make Australia go round. You know, we've got $4.5 trillion in superannuation. Without audits making sure all our capital markets work properly, then everything sort of falls apart. So audits are really important. We need to be able to trust audits. We need to be able to trust auditors. And what we've heard today is that there's big question marks over whether we can trust one of the country's biggest auditors, that's KPMG. So, Anthony, today opened with Lend-Lease, the property company, and that they came in and revealed how KPMG had used some of their confidential information to try and win audit work at other companies, including Westpac and Dexus. And basically, John Gillam, who's the chairman of Lend-Lease, says this was a fundamental breach of trust, and that they won't be working with KPMG again. His line was something like, how can we trust these guys to do the right thing? And it makes you worried about what else is going on. So naturally, that was leapt on by Senator Deb O'Neill, who's spearheading this inquiry. She made the point that, it's not just capital markets that need to trust auditors. It's KPMG itself that relies on the trust in auditors, because it's the brand name that audit gives you that allows KPMG to win all sorts of other work. And so there's this sort of cascade of trust that KPMG is now in serious trouble. I mean, Anthony, I know you saw Mr. Yates, the former CEO, and Martin Shepherd, who's the current chairman, sort of trying to cling to his job, I guess. What did you make of their evidence?
Oh, it's pretty interesting. I mean, Deb O'Neill really giving it to these guys. And I think, these senators have been through a few of these inquiries now, and they've really just not happy with some of this stuff. And some of the issues that have come back again from the PwC one a couple of years ago at KPMG, and just throwing them to KPMG's Andrew Yates and say, look, last time we spoke to you, there was this PwC going on in the background. You told us that, your firm was better for these reasons. Meanwhile, you'd been dealing with your own whistleblower complaint in the background. Like, why didn't you say anything at the time? And why put your firm up on this sort of pedestal when you know that there's these own inherent trust issues inside there? So, I mean, Yates really copped it. I thought, at least you did sit there and cop it and didn't storm out or something, because it was really one-way traffic directed at him. I thought, James, what struck me on the Lendlease one, though, did you hear when they said that Lendlease had been using KPMG for 68 years?
Yeah.
Like, that's like, so not only were they a big KPMG client, but they've been using them for 68 years.
Yeah.
Like, you think if there's one, auditor you think you trust, it's the one that's been looking after you for 68 years.
I think that's the problem, Anthony. Lendlease has absolute, or did have absolute trust in KPMG, and I think from the Lendlease side, that's why it hurts so much that this has happened. So, look, the inquiry's rolling on. I think it's going to roll on into the evening. The question probably becomes, Anthony, do any other heads roll at KPMG? Martin Shepherd, the chairman's probably most in the firing line. It's hard to say what's going to happen there. KPMG is claiming legal professional privilege over a lot of the documents that it's refusing to give to the Senate, which is rolling brawl with between the senators and lawyers and KPMG itself. So this is really a mess, Anthony. And I think probably the big message from today is this is far from over, right?
Oh, 100%. Like the irony of KPMG trying to keep documents to protect its own confidentiality when the whole reason everyone's sitting there is because some other company's confidentiality was breached is just gold.
Yeah.
And, that just reverberated, I think, around the day. James, were there any other bombshells that sort of caught your ear?
Oh, look, I mean, I think one of them was around that legal professional privilege.
Yeah.
Obviously, KPMG doesn't want to give it up. We had 3 independent KPMG directors all say, yeah, we should have handed those documents over. I mean, what a terrible look. So
yeah,
I think this is a mess. It's got a while to run yet. And Anthony, I guess our best advice for people, keep checking AFR.com, full coverage there, and we'll be pulling all this circus apart in great detail.
Yeah, just lastly, James, you've seen a few of these, more than me. What do you think the temperature's like in the room of these? Like, to me, this one seemed really quite dramatic, and there was absolutely no wriggle room for any sort of sympathy at all for KPMG. Like, have the senators, have the parliamentarians, have they dialed it up a notch?
I think they have. I mean, I think, Senator Barbara Pocock from the Greens, she keeps making the point. This is 2 out of the big 4 accounting firms have now been brought low by these scandals. 2 out of 4. Like, seriously, do we have a bigger problem with the entire industry here? And I think that's the question. That is why the temperature's been dialed up, as you say.
Yeah, I think they're getting better at the stunts as well. I mean, like, you're asking the former head of audit at KPMG how much he earns. He kind of fumbles around for a bit. They ask again, he fumbles around a bit more. They ask again, and he finally says, 1.7 to 1.8 mil.
Yes.
I'm not sure why that fact is needed and why it's needed on the public record. But, when you head to Canberra, they're trying to skewer you at the moment. And it's just little things like that stick in the mind.
Yeah, we'll keep following this one, Anthony, and plenty of water to go under the bridge here, I think.
Absolutely.
Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, big week ahead starts on 5 a.m. on Saturday morning with the mighty Socceroos taking on the might of the hosts, America. Anthony, what is your prediction for Saturday's game? In all seriousness, this is a very tough assignment, isn't it?
Yeah, tougher than the last one. I think, James, playing the US at home. The heart says go Socceroos, the head says it's going to be hard. But who knows? Maybe I'm starting to believe.
No, I'm going to say it's a 2-1 victory, the Socceroos.
Wow.
They do it for AUKUS and come out on top. All right, back to more serious business. On Wednesday, we get the monthly inflation data for May. Economists are thinking the headline number is going to be like 4.9% on an annualised basis, up from 4.2% a month earlier. Now, 4.9%, it's basically 5% inflation, Anthony. That's going to have That's had a few alarm bells ringing, isn't it?
2x target, James. Not good.
Yeah, good point. All right. The other thing is, Anthony, we're getting close to the end of the financial year, which is always a big moment for markets. There's some really good candidates for tax loss selling this year. Anthony, just tell us a little bit briefly about what tax loss selling is. Who are the big candidates this year, and are we going to see a barrage of this in the coming weeks?
Well, it's all about capital gains tax, James, which is very topical. But bear with me, people. Capital gains tax is great in a headline, but people don't often like to understand the details. So basically, if your shares have gone really badly in the past 12 months, the year to June 30, some people want to sell them to lock in the capital loss to then offset against gains maybe they've made somewhere else. I mean, there's some really big candidates this year. We've had some big falls, unexpected ones from big companies. So the share price of CSL, Cochlear, WiseTech, all down more than 50% this financial year, which is just amazing, James. But basically, the tax loss selling means that anything that's been hit hard over the past 12 months can sort of get hit hard again in that final week of the financial year, just as people try and lock in some of these capital losses. Funnily enough, though, James, I mean, it's the 19th of June today. What we've actually seen is these stocks have traded up this week. So if the tax loss selling's there, it's not going to happen till late. But yeah, I mean, there's a bit of question mark about whether it's going to happen this year or not.
Yeah, something to watch over the next couple of weeks. Well, we love questions here at the Chanticleer podcast. Our question this week is from Nick in Western Australia. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. We also have a widget on the bottom of all Chanticleer articles at afr.com where you can submit a question too. And we'll ask our super producer, Iona, to do the honours with Nick's question for us.
There seems to be a consensus that AI will considerably impact entry-level and middle management white-collar jobs by 2030. If this does happen, contributions to industry super funds may decrease and make them explore alternative funding sources to support retiree payouts through the asset sales. Could this create a widespread challenge across the industry? Could it force them to be sellers at the same time it is improbable buyers will emerge for many of their illiquid assets? Do they have a plan B?
This is a fantastic question, Nick, and I haven't thought of it in this way, Anthony. There's all sorts of ramifications to the job market from AI. There's all sorts of things that super funds need to be thinking about how AI might hit asset valuations. But Nick has brought these two things together really neatly. If we have a sort of slowdown in contributions from workers to super at the same time as we have an increase in payouts from super to a growing band of retirees, and we have falling asset values at the same time because the world's being changed by AI, that's a bit of a recipe for disaster, isn't it, Anthony? I'm not quite sure what the answer is, but I think Nick's defined the problem really well.
Yeah, total recipe for disaster, Nick, and 100% the super funds are already thinking about this. I mean, they put this in the liquidity bucket. So for them, it's all about matching the contributions and redemptions, which they've not really had to do so much before because they've been flooded with contributions. So whatever they have to pay out the other side, they're always going to have the cash sitting around to do it. But in the past year or two, we've seen the big super funds, Australian Super is a great example, they hire a chief liquidity officer because they know they're going to have to be more conscious of managing this liquidity problem. As James just said, I mean, that's before AI came along with the potential to disrupt the workforce today. So that could slow down their contributions. At the same time, their redemptions is increasing. How do they meet that? I mean, they have been thinking about it, but perhaps not with that AI potential, which could exacerbate the problem over the top. I mean, if it got to the point, though, where they're having to sell big private markets assets, stakes in toll roads or ports or
office
buildings, infrastructure, office buildings to meet redemptions, I mean, that would be a shocker. One thing it does do, though, Nick, I mean, the super funds love public markets because liquidity is always available to them. Yep. This should bring them back towards public markets. The fact that they having to be more conscious of liquidity, they're going to need more assets that if they have to, that they can turn into cash pretty quickly. And there's nowhere like public markets to do that.
Anthony, we got a super summit later in the year with the AFR. I think Nick's just given us the very first question we'll be asking in the very first session. So thank you, Nick. Well, Anthony, it's been another huge week, but before we go today, we've got something a bit special. Regular listeners will, of course, know that our Walkley Award-winning producer, Alex Gow, who's the head of audio here at the AFR, and of course the composer of the Chanticleer podcast theme song, but you might not know that he's also an ARIA award-winning musician, and he's got a new record out today. It's called Bodyline. You'll find it under Alexander Gow, wherever you listen to your music. And Anthony, I've got to say, this is a brilliant album. It's sweet, it's heartbreaking, it's joyous, it's a bit funny too. So massive congratulations to Alexander Gow on his new album Bodyline from everyone in the Chanticleer family. And to take us out today, here's a little bit of what I reckon is one of the songs of the year. This is Ruby by the Pool. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald. It was produced by Iona Rennie and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.